Okay, let's unpack this. We're diving into something pretty fascinating today.
Mm-hmm.
Well, frankly, a bit of a surprising shift happening in the world of U.S. bonds.
Yeah,
Now, you might not track bond funds daily, I get that, but what's going on here is actually a huge signal about the economy. It's, long-term health.
absolutely.
We're looking at recent data, and it shows U.S. long-term Treasury and corporate bond funds. They posted about $11 billion in net outflows just in Q2 2025.
11 billion. That's a chunky number.
It is. And here's where it gets really interesting. This is the most significant outflow, the biggest pullback we've seen since the 2020 pandemic hit.
Right. And if we kind of zoom out, look at the bigger picture. It
Yep.
actually marks the fourth largest quarterly outflow over the last 12 years.
Yeah.
So not just since 2020.
Fourth largest in 12 years. Okay, wow.
Yeah. And what's particularly striking, I think, is the contrast. It's so stark. These exact same funds, they typically saw an average inflow of around $20 billion.
Wait, inflow.
Yeah, inflow. An average of $20 billion coming in during the previous 12 quarters.
Okay, so you go from plus $20 billion on average to minus $11 billion.
Exactly. So this isn't just a blip on the radar. It's a dramatic reversal, a real U-turn.
It certainly seems like it.
And it raises a really important question for us, doesn't it? Why are these major institutional players, the ones who usually crave stability, especially in long-term debt,
Yeah.
why are they suddenly pulling back and with such force?
Right. So what does this actually mean for you listening? These bond funds, as you said, they're mainly used by the big guys, right? Institutional investors.
That's right. Think of massive pension funds, insurance companies, sovereign wealth funds even.
Huge pools of money.
Huge. And they manage these enormous long-term liabilities. So their actions, where they put their money, it acts as a really crucial proxy for overall investor sentiment.
Okay, a kind of bellwether.
Exactly.
Yeah.
Especially regarding long-term economic stability. And the recent outflows, as our sources are indicating, they continue to reflect these growing concerns over ongoing deficit spending.
Ah, okay. So it ties back to the deficit.
That seems to be the crux of it, yeah. When a nation consistently runs significant deficits, especially over a long time, it just raises fundamental questions for bondholders. The core worry, really, is often about the government's ability to manage that debt down the line.
Without doing what? Like printing money?
Well, without resorting to measures that could devalue the currency, like, excessive money printing or maybe future tax hikes that could potentially slow down economic growth, those are the fears.
Got it.
And in the context of these long-term bonds, investors are essentially trying to price in that risk. The risk that maybe inflation eats away at the value of their future repayments.
Right.
Or maybe just the sheer volume of new government debt hitting the market will require higher yields, higher interest rates, just to attract buyers.
And we're not talking small retail investors making these moves.
No, not at all. We're talking significant capital shifts by institutions whose whole job, their mandate, demands long-term stability and predictable returns.
So when they sniff out growing risk, they adjust.
They just.
Yeah.
Exactly. And the practical implication of that, well, if these large investors start demanding higher yields to hold U.S. government debt,
It gets more expensive for the government to borrow.
precisely, it drives up borrowing costs for the government itself. But, the ripple effect doesn't just stop there.
Ah, right, it spreads.
Exactly. Those higher government borrowing costs tend to, flow through the entire economy. It can mean higher interest rates for companies trying to borrow.
For mortgages.
For mortgages, for consumer credit, car loans, you know it. There's this phenomenon, it's often called crowding out,
Out, yeah.
where heavy government borrowing essentially competes with private sector borrowing for the available capital, making money more expensive for basically everyone.
Okay, so the market is basically saying, what we need more compensation.
That's a good way to put it. It signals the market is demanding a higher risk premium to hold long-term U.S. debt, effectively saying, look, we need more compensation for the perceived long-term risk tied to these levels of government debt.
So this outflow, this $11 billion figure, it's not just a number on a spreadsheet somewhere.
Not at all.
It's a really loud signal about future economic expectations. It suggests the smart money, as they say, is actively pricing in the consequences of where things are heading fiscally. It's about more than just the $11 billion figure itself. It's about what that kind of pullback implies for future borrowing costs and, potentially the future value of the dollar.
And that's precisely why this trend is so important for you, for everyone to understand. It's a powerful indication of what major financial players are thinking about the future, not just next quarter, but years, decades down the line.
So wrapping up this deep dive then, the clear signal from this pretty significant pullback from long-term U.S. bond funds, remembering it's the largest since 2020, is really this heightened level of concern among major investors.
Concern about the nation's deficit trajectory.
Yeah, it's a direct reflection, isn't it, of how the market is reacting to those concerns right now.
Absolutely. And if we step back, look at the broader landscape again, this trend in bond outflows, specifically linked to deficit concerns. It isn't just some dry statistic.
Right.
It's a critical barometer. It tells us how the financial world views long-term economic stability and, crucially, the future cost of capital. It's a powerful sign of what that smart money is pricing into the future. Definitely something for you to consider as you navigate the economic waters ahead.
It certainly begs the question, doesn't it? If the biggest players are adjusting their sales this significantly now, what might that mean for the rest of us down the line? And, how will it influence the broader economic current going forward? Lots to think about there.